You don't need fluff. Let's cut straight to the gut punch. Crypto derivatives markets have reached levels of positioning we haven't seen since the collapse of FTX in 2022. According to a fresh report from Bybit and Block Scholes analytics, the markets are showing the most extreme positioning since that meltdown. What's extreme positioning? It means traders are stacking insanely leveraged bets, a lot of them huge bets on price direction, that can blow up spectacularly when sentiment turns. This isn't amateur hour speculation. This is professional, institutional, and big money players pushing enormous capital into derivatives, futures, and options, trying to amplify returns. And right now, the pendulum has swung toward maximum risk. Here's the naked truth. Derivatives markets don't lie. They tell the real story of capital flows. When spot trading looks calm, but derivatives positioning goes bananas, you know markets are being run by leveraged bets, not fundamentals. In the last week alone, Bitcoin briefly dumped to around $60,000 before bouncing back above $70,000, triggering a cascade of liquidations and deeply negative funding rates across major altcoins, something we haven't seen outside of massive market stress moments. Look, if you're building wealth, you have to understand this. Derivatives markets are where the big money wins or loses the big battles. Price volatility in spot markets is like surface waves, but derivatives are the deep ocean under them, where institutional sharks operate. Extreme positioning signals a high risk of violent price moves, which means massive opportunities and massive risk. This isn't about Bitcoin going up or down. It's about the psychology of money on steroids, leverage, collective bets.
2. Anatomy of the beast, derivatives, and why they are the real market movers.
To build an empire, you don't pretend you understand something, you really understand it. So here's the brutal truth about derivatives markets. In finance, derivatives are contracts whose value depends on the price of an underlying asset. In crypto's case, Bitcoin, Ether, and other digital assets. They allow traders to make leveraged bets and to hedge risk. But leverage is a double-edged sword. It magnifies profits when you're right, and it obliterates your capital when you're wrong. Right now, the positioning, especially in Bitcoin and Ether futures and options, is at record extremes. Traders have taken on massive long exposure, even though prices have roller coastered from $60,000 to $70,000. This created conditions where forced liquidations can cascade, pushing prices far more violently than spot market moves would. This isn't a theory. Derivatives markets have already seen unprecedented liquidations and pricing anomalies in 2026. For example, Bitcoin's derivatives market recently experienced an 11,588% liquidation imbalance, according to data, meaning one side of the market got absolutely crushed. And don't think this only affects wild retail traders with high leverage. Institutional players have massive skin in this game. CME Group, the massive regulated exchange, even noted record demand for crypto assets and is planning to expand offerings and 24/7 trading. So here's the power move insight. Derivatives drive liquidity and volatility. They signal where capital is flowing, not just emotion. When derivatives are at extremes, the markets behave unpredictably. That's not a warning. That's knowledge, and knowledge is leverage.
Why this extreme positioning is a warning sign, not just another crypto bubble. People get excited when they see massive trading volumes, like the $86 trillion in crypto derivatives traded in 2025. But volume alone doesn't mean healthy markets. Volumes rising doesn't equate to stability. It shows the market's addicted to action. It means traders are not holding assets for long-term value. They're betting, hedging, and speculating with borrowed money. That's when markets are most fragile. This current crash and rally pattern shows the craziest part of trading psychology. When markets are up, everyone goes long. When markets fall, liquidity dries up. And when forced liquidations hit, markets drop faster than they rise. When markets are up, everyone goes long. When markets fall, liquidity dries up. And when forced liquidations hit, markets drop faster than they rise. In this environment, derivatives become a risk amplifier, not a cushion. This is why experienced traders don't just look at price charts. They watch open interest, funding rates, and leverage metrics. When those go extreme, the market is at risk of violent moves. Right now, we're seeing one of those setups. Let's be real.
that kind of extreme behavior didn't just happen because Bitcoin went down 10%. It happened because leverage was already stacked high and sentiment was precarious. Once liquidity tightened and prices broke key levels, the market exploded from the inside out. That's how volatility spikes happen. If you want to build something real, a business, a hedge fund, or financial independence, you don't ride every hype cycle. You understand structural risk, capital flows, and systemic signals before they blow up in everyone's faces. And here's the bitter truth. Most people will never understand that. They'll chase headlines, they'll buy top, they'll sell bottom. You don't need to be like them. How smart money is reacting, and what you should learn from it.
Here's the lesson the big boys already know. Liquidity dries up first and leverage hits last. When markets shift from risk on to risk off, derivatives positioning gets unwound fast, but spot liquidity disappears faster. That's what creates those flash crashes and violent rebounds. Bitcoin falling to 60K, then recovering, that wasn't random. That was pressure being released in the derivatives layer. Blockfills, a major crypto lender, just halted client withdrawals because Bitcoin's slide hurt liquidity. That's not an isolated event. It's a symptom of institutional cracks showing under stress. Now learn this. The real money doesn't panic when this stuff happens. They profit from it. They use structural breakdowns to buy distressed assets at discount, hedge risk smartly, and allocate capital where fundamentals remain strongest. Cheap volatility isn't a danger. Unmanaged volatility is. Professionals hedge, diversify, and allocate capital dynamically. That's how you build real wealth. If you're watching this crash from the sidelines and thinking crypto is done, you missed the market signal. If you think crypto is easy money, you will get burned. But if you see this as an opportunity to understand deeper market mechanics and build real strategies, then you're already thinking in a winner's mindset.
What this means for you. A roadmap to profit, not panic.
Now, here's where most people flinch, but you don't. Markets like this can reward clarity and punish confusion. When derivatives go extreme, verified potential. Volatility equals opportunity. Traders who understand risk metrics can enter asymmetric positions, where their potential upside dwarfs downside risk. Liquidations reset markets. That creates fresh entry points for long-term positions. Institutional flow signals direction. When institutions hedge futures, you can ride the wave. Volatility equals opportunity. Traders who understand risk metrics can enter asymmetric positions, where their potential upside dwarfs downside risk. Liquidations reset markets. That creates fresh entry points for long-term positions. Institutional flow signals direction. When institutions hedge futures, you can ride the wave. Never use reckless leverage. You're not gambling, you're allocating capital. Don't chase rebounds blindly. Understand why prices move. Don't treat spot price as the only truth. Derivatives tell the hidden story. Never use reckless leverage. You're not gambling, you're allocating capital. Don't chase rebounds blindly. Understand why prices move. Don't treat spot price as the only truth. Derivatives tell the hidden story. Here is
Why derivatives extremes aren't just noise. They tell you where the real battle lines are drawn.
You've already heard the headlines about extreme positioning, but why does that matter? It matters because derivatives are where smart money, hedgers, and leveraged speculators collide with the rest of the market. These aren't random price swings in spot trading. This is real positioning and capital allocation signals, and they're screaming at you right now. At their core, derivatives markets, especially perpetual futures and options, represent expectations of the future, not just opinions about the present. Unlike spot markets, derivatives let traders bet on price direction, hedge existing holdings, and leverage positions. The balance between long and short positions, along with open interest and funding rates, reflect collective beliefs about where prices are headed. Here's what's happening at a structural level right now. Volatility spikes are not random. Short-dated BTC and ETH volatility has surged to levels last seen during the 2022 FTX disaster, with 7-day implied volatility crossing 100% in some cases. That's not a mild shake. That's the market baking in extreme uncertainty and demand for protection.
Positioning is at record extremes. Derivatives traders are piling into leveraged bets, and when a majority of money is on one side of the boat, it creates pressure points. If those bets are wrong or unwound suddenly, the resulting price moves are violent. That's how flash crashes and explosive reversals happen. Markets are emotion-driven, but structure matters. When funding rates become overheated, especially when long positions dominate, you get what people in institutional trading call a crowded trade. These setups have historically preceded big drawdowns because crowded positioning means a small catalyst can trigger a waterfall. Volatility spikes are not random. Short-dated BTC and ETH volatility has surged to levels last seen during the 2022 FTX disaster, with 7-day implied volatility crossing 100% in some cases. That's not a mild shake. That's the market baking in extreme uncertainty and demand for protection. Positioning is at record extremes. Derivatives traders are piling into leveraged bets, and when a majority of money is on one side of the boat, it creates pressure points. If those bets are wrong or unwound suddenly, the resulting price moves are violent. That's how flash crashes and explosive reversals happen. Markets are emotion-driven, but structure matters. When funding rates become overheated, especially when long positions dominate, you get what people in institutional trading call a crowded trade. These setups have historically preceded big drawdowns because crowded positioning means a small catalyst can trigger a waterfall. Here's the real lesson. Extreme positioning isn't noise, it's a structural risk metric. And if you want to make money rather than lose it, you have to read these signals the way professional traders do, rather than chase price charts like a day trader on Reddit.
The hidden layer: open interest, funding rates, and market stress signals you must watch. If you want to dominate markets instead of being dominated by them, you need to look under the hood, beyond price charts, and into the derivative metrics that actually drive big moves. Open interest, the real liquidity indicator. Open interest tells you how many derivative contracts are active. When open interest rises, it usually means new money is entering the market. When it falls sharply, it means positions are liquidating, which often happens after major sell-offs or forced closures. Recently, open interest plunged sharply, signaling that over-leveraged positions were wiped out, and that's actually a necessary cleansing before a healthier trend can reestablish. This is the kind of move institutions wait for, a full reset before re-entering at better prices. Funding rates, the temperature gauge. Funding rates are a perpetual futures mechanism that keeps futures prices aligned with spot prices. When funding rates are high positive, it means longs are paying shorts, indicating bullish but overheated sentiment. When they go deeply negative, it signals bearish pressure. Right now, certain derivatives markets, especially Ethereum, are showing critical warning signs in funding rates, consistent with over-leverage ahead of corrections. Sentiment and fear metrics back up these hard-on-chain signals with market psychology. Fear is spiking. The Fear and Greed Index is deep in panic territory, meaning most participants are emotionally capitulating. That's often a contrarian buy signal, not a reason to panic. Here's the brutal lesson. Prices move violently, not because fundamentals change instantly, but because leverage unwinds in chaos. Knowing where funding rates and open interest stand lets you stay one step ahead of forced liquidations. The Institutional Playbook: How Pros Use Derivatives to Dominate Trends.
Savvy money doesn't ride the hype, it plays the structure. Institutions and quant teams look at derivatives data first, price action second. That's why these metrics are the heartbeat of professional trading strategies. When institutions see extreme positioning, high implied volatility, sharp shifts in open interest, they don't just react, they allocate capital accordingly. Extreme positioning, high implied volatility, sharp shifts in open interest, they don't just react, they allocate capital accordingly. Let's break down how they think. 1. Use volatility like a radar. Volatility isn't a danger, it's data. High volatility means there's opportunity for asymmetric trades where profit potential far exceeds risk, but you only take those when your risk management is airtight. 2. Hedge, don't guess. Pros rarely bet without hedging. They might hold a long spot position and a short futures hedge to protect against drawdowns.
Your average retail trader doesn't do that. They either bet all in or panic sell. 3. Wait for structural triggers. Rather than chase pumps or dumps, institutions watch for liquidation cascades, funding rate extremes, and open interest shifts. Those are the real triggers of trend changes. 4. Capital efficiency is the name of the game. Your job isn't to make every trade, it's to make the right ones. That means balancing spot risk, derivatives exposure, portfolio diversification, cash allocation. Spot risk, derivatives exposure,
What this means for anyone actually trying to build wealth, not gamble.
Let's be brutally honest. Most people talking about crypto only care about the price headlines. But you're not most people. Here's the truth no one else will tell you. Derivatives markets are where fortunes are truly made and lost. Reading the right metrics always beats blindly guessing price direction. Remember, risk management isn't optional. It's absolutely crucial for survival. And those sentiment extremes, they're powerful signals, not excuses to panic. If you want to build something real in this space, you must internalize this. You get paid for understanding risk before price moves. When everyone else is caught in emotion, you'll profit from structure. Crypto derivatives markets are not a casino, unless, of course, you treat them like one. The professionals don't gamble. They calculate, they hedge, they meticulously manage exposure, and they exploit emotional behavior throughout the entire cycle. So here's your final task. Watch the metrics that truly matter: open interest, funding rates, implied volatility, and always tie them back to structural risk. That, my friends, is the fundamental difference between a trader who survives multiple cycles and a gambler who ultimately gets wiped out.